Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Progressive Care stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Progressive Care is a personalized healthcare services and technology company. The company is headquartered in Florida and was founded in 2005. It went public in 2010 and currently trades OTC. Last year, the company conducted over 4,700 COVID-19 tests that resulted in $600,000 of revenue. It provides prescription pharmaceuticals, over 500,000 last year. It also sells antiretroviral medications and also therapy management. In February of this year, it entered into a service agreement with Eagle Force Health to integrate its telehealth platform, MyVax, into a digital wallet that is QR coded for registration, verification, and documentation of COVID-19 vaccination and test results. Let's get started with the model. This is a micro-cap company, 60 million market cap. They're trading at 12 cents a share, and they have 486 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they had negative free cash flow every year, except in 2020, it was positive 500,000. Net income is the profit and loss on the income statement. It's revenue minus expenses. And that's pretty much negative every year. Revenue is the sales for the company, and that doubled from 2017 to 2020. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. An example is the cost of labor. And the difference between those two numbers is their gross profit. And that grew to $9 million in 2020. Below that is operating expenses. And their operating expenses are higher than their gross profit almost every year. So they have negative net income most years, except in 2017. Below that is the interest they pay in their debt. They paid the most interest in 2020, 1.7 million. Below that is other income and expenses. This is usually impairments or write-offs. Then your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which is pretty much negative every year since they're still growing their business. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generated or lost from its operational business. That's a really good sign they had positive operating cash flow in 2020, 1.1 million. It was negative in prior years. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. Then you have capital expenditures, which are investments in property, plant, and equipment. They probably have to purchase a lot of expensive equipment. They had nearly $700 million in CapEx in 2020. Operating cash flow minus CapEx gives you your free cash flow. And they had positive $500,000 in 2020, negative in prior years. Since they had negative free cash flow in prior years, they used debt to run their business. They issued over $600 million in 2018. They did pay down $90 million, so they added about $500 million of debt that year. They increased their debt load $3.5 million in 2019, and they increased it $800,000 in 2020. Let's look at the capital structure. Negative $2 million of equity. That means their liabilities are $2 million more than their assets, and $4 million of debt. So they're 100% debt, 0% equity. Their net debt is $2 million, and their WACC is 11%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 135 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $103 million. And we get a calculated stock price of 21 cents. They're trading at 12 cents, so they're trading at a 41% discount. It's a strong buy according to the model. No other companies are valuing this stock, so it's really hard to value a company with negative free cash flow. So I estimated their future free cash flow based off of their previous growth. I also tried to estimate their future revenue and expenses based off of their current projects and future projects. This is the stock price the last 5 years. So it did break through 20 cents at one point, which ironically is pretty close to my valuation. Then it came way back down, but the price was driven up the past few weeks. So if you bought it down here, you could have made a great return. They have a pretty low beta, 0.43, so the stock moves half the market. The stock has gone up 228% in the past 52 weeks, while the S&P 500 went up 50%. The 52-week low was 2 cents, the high was 19 cents. The stock is trading above its 200-day but below its 50-day moving average. About 2.5 to 5 million shares are traded each day on this stock. They have 486 million shares outstanding. In the past year, this stock has gone up 236%, while its industry went up only 24% and the market 58%. In the past 5 years, this stock has outperformed the market and its industry, but not in the past 3 years. The stock has done worse than its industry and the market. If you invested $10,000 into this company 10 years ago, you'd be at $3,100 today. That's 11% annual loss. Let's look at the financial ratios. The average PE in the market's 32, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so we can't look at the PE. Price to sales is stock price over sales per share. They're at 1.6. So investors are paying $1.60 for $1 revenue. Price to book is stock price over book value per share. They have negative book value, so we can't look at the price to book. Their return on invested capital is negative since they have negative operating income. Also, part of the interest coverage ratio calculation is operating income, which is negative, so they have negative interest coverage ratio. We can't look at the ROE since they have negative equity and negative net income. Current ratio is current assets over current liabilities. They can cover only 70% of their current liabilities with their current assets. And their current assets are $2 million of cash, $3 million of receivables, and $1 million of inventory. So the company does seem to be undercapitalized. They had $500,000 of free cash flow, negative $3 million of working capital, so they're short about $2.5 million. They're going to need more debt or equity to run their business over the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. The only other companies in the same industry are PetMed Express and Walgreens, and Progressive is worse in every single category. So to summarize, I have them trading at a 41% discount, but this company could be a really big company one day and you can make a ton of money, or it could just fizzle away if it doesn't get enough funding. It is a lot more risky investing in penny stocks, but greater risk yields greater reward. I rank their free cash flows 4 out of 10, their revenue 6 out of 10, and their ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.